Tokyo took a more reserved stance. Prime Minister Shajir Sheba acknowledged that, although the dialogue had laid groundwork, a clear divide remained between both parties. It began with tariffs, the familiar kind: loud declarations, flashy headlines, promises to bring jobs back home. But someone overlooked the fine print because on April 3rd, 2025, the U.S. imposed a 25% tariff on cars assembled in Mexico and Canada. The intention? To target foreign competitors. The result? It blindsided Japan. Not just any part of Japan, the part responsible for manufacturing one in every three cars on American roads. Toyota, Honda, Nissan, caught in the crossfire of a policy that wasn't even aimed at them. As Washington celebrated, Tokyo went quiet. No press statements, no outrage, just stillness followed by a quiet pivot. Production began shifting to Southeast Asia. Japan ramped up its electric vehicle plans, and the American supply chain, it didn't collapse. It started bleeding. What the U.S. called trade policy, Japan interpreted as an economic attack. Tariffs aren't new. They're clunky tools, good for headlines, slower to affect the ground. But the 25% auto import tariff that hit in April 2025 wasn't just a policy move, it was performance. Washington claimed it was going after bad actors. The crowd applauded, analysts approved. But beneath the patriotic packaging was a costly mistake. The vehicles in question weren't from China, they were from Japan. For decades, Japan had built cars near its top buyer, America, not to compete against U.S. manufacturing, but to complement it. Toyota in Baja, Honda in Ontario, Nissan in Aguascalientes. These weren't loopholes, they were connections, shared supply chains between allies. Washington either didn't see that or didn't care. The White House made its announcement. The tariffs hit, and somewhere in Tokyo, a senior executive quietly said, "So they really did it. No retaliation, no diplomacy, just movement." In a matter of days, Japanese automakers began recalibrating. Honda shifted production of the Civic Hybrid from Mexico to Indiana. Nissan reduced Rogue production in Japan. Toyota accelerated EV and hybrid manufacturing outside North America, not out of anger, but because they saw it coming years ago. Back in 2018, when America First became more than a slogan, Japan had begun preparing. To Washington, this looked like a win. To Tokyo, it confirmed a long-standing risk. And they didn't panic. They simply followed a strategy they'd already written. In Detroit, suppliers crunched numbers. Dealers prepped for delays. Consumers barely noticed until prices rose and wait times stretched into the next quarter. Here's the twist. The tariff that was meant to boost U.S. car sales helped no one. Because Japanese brands aren't just popular for price, they're trusted. And when trust cracks, innovation steps in. If you're still watching, you're not just tracking headlines, like you're witnessing the playbook behind them. Subscribe before the rest catch on. Japan didn't blink. No emergency meetings, no media frenzy. Just quiet, calculated moves. They didn't need a dramatic response because they'd been laying the groundwork for 7 years. Since 2018, Japan's automotive titans had quietly evolved. They spread out their supply chains, poured money into research and development, plotted every possible weak point in the global system. So when the tariffs landed, they didn't hesitate. They acted. Honda announced the Civic Hybrid destined for Mexico would be made in Indiana. Not as a favor, but to safeguard market access. Nissan began scaling down Rogue production at home. Toyota fast-tracked hybrid and electric vehicle lines from Thailand and Japan. This wasn't reactionary, it was a carefully executed logistics strategy. Quiet, methodical, and deeply strategic. Factories across Southeast Asia ramped up, not just for cheaper labor, but as insulation from political volatility. Thailand, Vietnam, Indonesia, new pieces on the global chessboard. By the time American lawmakers asked, "What now?" Japan had already restructured, and while they realigned supply chains, they also leaned into their long game. Innovation. Toyota pushed solid-state battery development at a record pace. Nissan expanded its compact electric vehicle strategy, targeting the one market segment U.S. companies had ignored. Honda sourced next-gen battery materials from suppliers outside the U.S. This wasn't just about cars anymore, it was about control. Control over technology, perception, and the future. And in Japan, the message was clear. This wasn't retaliation. It was evolution. No tit for tat, no bluster. They planned to win by outlasting, outbuilding, and outsmarting. No grandstanding, just factories. Just engineering. Just movement and silence. And in that silence, something profound shifted. The U.S. expected a trade war. What it got was a quiet battlefield where Japan had already taken the high ground before the first blow. You'd expect a 25% tariff to flatten a country? But Japan didn't fall. They bent, then pivoted so sharply the whole game board changed. While Washington tallied short-term wins, Japan went global. And without much fanfare, they stopped depending on America. This wasn't revenge, it was resilience, fueled by speed, diversity, and new alliances. Plants in Mexico and Canada were scaled back. Thailand, Vietnam, and Indonesia ramped up. Because labor costs are lower, regulations are smoother, and perhaps most importantly, none of those countries are springing surprise tariffs on their trading partners. Southeast Asia became Japan's new industrial shield. The EU became a diplomatic anchor. And the US. While Americans started asking why their Civic Hybrid now costs more than their mortgage. Dealerships reported delays, markups, and annoyed customers. But oddly enough, US automakers didn't see a massive sales bump. Turns out loyalty doesn't vanish overnight, even if your car is now made in Bangkok. Japan didn't slow down. Battery tech, hybrid platforms, marketing that leaned into reliability, not flashy, just lasting. We don't make the loudest cars, they implied. We make the ones that still run after 300,000 miles. Despite the tariffs, Japanese automakers absorbed costs, offered incentives, and held their U.S. market share above 35%. They didn't just weather the storm, they stayed at the top. And behind the scenes, Japan's government made one subtle surgical move. The Ministry of Finance began scaling back U.S. investments. Not enough to crash anything, just enough to say, we no longer place our bets on you. And that, more than any tariff, stung. Because this isn't about Q2 numbers. It's about who's still winning in 2030. Japan? They're playing for 2030. The US? They're playing for November. The irony? Tariffs were meant to bring jobs back. But by mid-2025, the only thing booming was the phone lines at US dealerships, ringing with complaints about delays, shortages, and price hikes. Politicians sold it as a manufacturing victory. Reality told a different story. Japanese car makers didn't just make vehicles, they built ecosystems. When companies like Toyota, Honda, and Nissan entered the American market, they didn't merely ship cars across the ocean. They invested heavily in local infrastructure, creating a complex and deeply interconnected network that extended far beyond the assembly line. Thousands of suppliers, from small family-owned machine shops to massive parts manufacturers, became vital parts of this web, each one specializing in components essential to building reliable, affordable vehicles. Logistics hubs sprang up across the country, coordinating the movement of millions of parts to dozens of production facilities. These hubs weren't just warehouses, they were sophisticated operations centers, managing supply chains that had to deliver precision on a global scale. Parts manufacturers, too, weren't limited to big cities. They populated towns and rural areas, creating jobs where few other industries could thrive. Service providers formed another pillar of this ecosystem. From auto repair shops to software developers working on next-generation vehicle technologies, Japanese automakers helped stimulate a wide range of industries across America. Every car sold represented not just a point of sale, but the activation of an entire support economy that fed countless local businesses and communities. This embedding into the American economy made Japanese car makers not just foreign manufacturers, but key stakeholders in the U.S. economic fabric. Their presence brought stability, innovation, and long-term partnerships, all of which extended well beyond the immediate automotive industry. It wasn't just about building cars. It was about building enduring, mutually beneficial systems that shaped economies at every level. When production slowed, those ecosystems began to strain. In Michigan, suppliers raised red flags. In Texas, near Toyota's U.S. headquarters, rumors of relocation began to spread. And American automakers, well, they couldn't fill the gap. Why? Because Detroit had spent the last decade chasing pickups and SUVs, leaving the compact and hybrid market wide open. And now, with gas prices climbing again, consumers wanted the very cars Japan specialized in. Only now they were harder to find. Washington tried to spin it as a win, but the real cost wasn't economic, it was trust. Japan had always been the quiet ally, reliable, steady, a partner that didn't retaliate and just delivered.